Good evening, everyone. My name is Hugh Chung, Chief Investment Advisory Officer at Endowus. I'm joined today by Christophe Beret, Senior Money Market Portfolio Manager from Amundi, and Catherine Zhang, Portfolio Manager of the Liquidity Investment Team with HSBC Asset Management. The webinar today is brought to you by Endowus in partnership with Amundi and HSBC Asset Management. And the topic today is to look at how we can best utilize our cash savings in a high interest rate environment. Next page. So we'll go through some usual disclaimers for Endowus as well as for HSBC and Amundi. So next page. So the US Federal Reserve has raised rates 11 times since March 2022 to target range of 5.25% to 5.5%, the highest level since the 2000s. And we're faced with a decision to keep the this money in either bank savings, fixed deposits, or money market funds. We could also use this capital for investments into bonds or equities, but we assume for today's topic that the capital is for cash set aside for short-term use only. So if we go to the next slide, before we start, we will actually take a quick question on Slido. As you can, if you haven't already accessed it, you can go through Slido. And the question for the first poll is, what are you doing with your cash right now? Are you putting it in bank savings, fixed deposit, or money market and cash funds? So we'll give it a little bit of time for you to put in your polls. And I think we will have the results fairly soon. So we will take the results and then we will carry on with a further part of the presentation. Okay, are we gonna have the results? Okay, actually, we're still waiting for the results to formulate. Okay. So I'm not sure this is the complete end results. We're still only 5 people. Should we wait a little bit more? Okay, so at least it's not a big sample, but we have more of the people in money market funds, which is good news, and the least amount of people in bank savings. Okay, that's good result. Let's go to the next slide. So I'll first start off by explaining who we are at Endowus, and then I'll hand the presentation over to Catherine, and then followed by Christophe to discuss HSBC and Amundi's money market funds. So first on Endowus, who we are. Next page. So those of you who don't know who we are, we're a digital wealth platform based out of originally out of Singapore, now in Hong Kong as well. We're a conflict-free advice, institutional access, low fair fee platform. So the 3 pillars of Endowus is really that we give advice, institutional access, and low cost. And as you can see in this page, our investors include, the biggest investor are Endowus employees, but we have investors such as UBS, Citi Ventures, Lightspeed, Samsung, EDBI, etc. Next page. So as discussed before, the 3 pillars of Endowus is that we are an advisory-led platform. Advisory-led means that we're aligning to goals of our clients. We also have access to the world's best investment strategies, and we bring low-cost access to our clients by giving institutional share class, or in the times when we get rebates, we give all the rebates back to our clients, therefore creating a conflict-free, transparent, fee-only business. The word Endowus is actually short for endowment investing for all of us. Next page. So here's the leadership team behind Endowus. The co-founders are Sam Rhee and Gregory Van, but we have a very wide bench and deep bench of talent, of total of around 150 plus people, both in Singapore and Hong Kong. Next page. And we work very closely with our FMC partners, which include Amundi and HSBC that we have here with a webinar today, but with many, many other world-renowned FMC partners, as you can see on this page, both in the mutual fund side as well as alternative investments. Next page. So the focus today is really on the cash management side, as discussed before. And as you can see, depending on your needs and depending on your goals, we segregate the capital that you have for investments into different investment periods. Now, the cash managements are normally for cash that you're putting aside for a rainy day, or you have some cash flow needs in the near future, or generally needs that you can't afford to have any sort of real drawdown of capital within the period that you need the money. So this is really the focus of today's discussion. Next page. So we'll take a look at how to take advantage of the high interest rate environment that we're seeing right now. So we'll discuss kind of the path, how we got there, and the outlook going forward. Next page. So as you can see in this chart, the rate hike cycle that we've seen over the last close to 20 months has been the fastest rate hike cycle in over 40 years. So you can compare the rate hike cycle in previous sequences in 1980s, as well as 1994, 2004, etc. The current cycle, as you can see, which went from basically close to zero to up to the 5.25 to 5.5 that I've explained, has been a very, very rapid pace. And that's why, in our memory, only a few years ago, you could not get a very big yield on your fixed deposit on your money market fund, whereas now the money market funds, particularly on US dollar basis, would offer you over 5% yield. Next page. So then how do you take advantage of this environment? Can you go to the next page, actually? Yes. So this is another page that shows you how rapid the interest rate cycle has been compared to the last 20 years. So coming out of the global financial crisis, the interest rate has been at a very low level for a very long time. And then as we went through 2019, interest rates have moved, above 2%. But then COVID happened. And then since then, we had this very, very large or quick interest rate hike where we have what we call the Fed funds rate at over 5%. And because of that, money market funds were essentially a combination of, short-term treasury, fixed bank-to-bank deposits are also at very, very high rates. So essentially risk-free type yields are giving you over 5%. Next page. Now, what are money market funds? Money market funds are funds that invest in highly liquid securities that generally tend to exhibit very, very low volatility. So if you look at some of the cash products available in our platform, although with some of them have short track records, the liquidity, the volatility that you're talking about is max drawdown of something like 0.4 basis points, so 0.004% or 2 basis points. So very, very little volatility in these products. Common objectives of money market funds include capital preservation. So it's very important that you don't lose money. It provides liquidity, and the returns are in line with or better than prevailing money market rates. So what do they invest in? Like we discussed just now, bank deposits, which are typically very short maturing, sometimes overnight. Then we have treasuries or other government agency issued securities, and in some cases, short-term credit by very, very high quality credit corporates. So what should I invest in money market funds? It's really for funds that you're putting up for rainy day funds, near-term expenses, and money you care for capital preservation. So again, the main thing here is that these are investments for money that you cannot afford to get a drawdown. Now, what we have to make sure that we're clear is that money market funds are not capital guaranteed, unlike bank savings and fixed deposits. So they do involve risks, but as you can see in what they commonly invest in, which include bank deposits and treasuries, they are very, very safe investments. Next page. So when we do a comparison of some of the, the main ways we put away our cash, like we discussed in the beginning, the three probably most common ways that we do it in the poll are fixed deposits, bank savings, and money market funds. So as you can see in this chart, both fixed deposits, bank savings, the issuers are banks. They are capital guaranteed, and they don't have diversification because it's essentially taking the credit risk of bank. The yields are very different between bank savings and fixed deposit. So bank savings currently give you somewhere around 1%, whilst fixed deposits will give you somewhere between 2 to 4%. And the reason why fixed deposits have higher interest rates is because they're locked up, right? So they're fixed for a certain period of time, where if you break that, you'll get a penalty. And normally they have a minimum investment that's above a certain level, in a lot of cases, 10,000 Hong Kong dollars, whereas bank savings have no minimums, but their yields are much, much smaller. Now, compare that to money market funds, where currently US dollar money market funds, for example, are giving you 5.1 to 5.3% as of September 2023. So these yields are comparable or higher to fixed deposits, but they are not locked up. So it's very, very liquid, normally on a daily liquid basis. So the catch is, though, that it's not capital guaranteed. So it's very, very safe investments, but it's not capital guaranteed. And the pros are that it has higher yields with daily liquidity. Now, again, money market funds are not capital guaranteed, but they are relatively safe investments. Next page. So what do we have on our Endowus current platform? There's two ways to really access money market funds on the platform. One way is to buy single money market funds themselves. So we have the HSBC US dollar, Global Money US dollar fund, which Catherine can talk about a bit later. We also have the Amundi Cash US dollar fund, which Christoph can talk about a bit later. Again, yields are all above 5% on a Hong Kong dollar basis. For retail, we offer HSBC's Global Money Market Hong Kong Dollar Fund at 5.1%. So it can be accessed on an individual basis. But next page, we've also created portfolios where we diversify underlying funds into two or more funds, in this case, 2 funds. We have 2 separate portfolios. One is Cash Up Simple. The other one is Cash Up Plus. Cash Up Simple deals with portfolios that have durations below 60 days on average, or average 60 days. The Cash Up Plus has less than 1 year of duration. Currently, the projected yields, net yields after fund level fees as well as Endowus fees are quite similar at 5.1 to 5.3%. But this is also because duration gives you more protection on the downside if there is interest rate cuts in the end. But currently, Cash Up Simple has slightly less volatility and offering 5.1 to 5.3%. Cash Up Plus has slightly more volatility with a little bit more duration and protection, but both offering very good returns and very limited risk for drawdowns. Next page. So I believe this is my last page, and I'll hand it over to Catherine. So why invest in Endowus Cash Up portfolios? Again, there's no lockups, so it's daily liquidity. There's flexible cash managements. There's no penalty or commitments if you have to withdraw. And then if you think about the cost, There's lower cost but better yields. There's diversification because there's different investments in there. And then there's monthly monitoring and customization. So money market funds are actually cash solutions that are widely used by institutional investors. And I think retail investors are getting more used to the idea of investing money market funds. But I believe that if you're comfortable with the risk entailed with money market funds, which we believe is relatively small, then this is a very good way to to invest in your cash. So with that, we will take the next Slido question and then hand it over to Catherine to discuss HSBC's money markets fund solutions. Second poll question is, what is most important to you when it comes to cash management? Is it higher returns? Is it lower risk? Is it speed of withdrawal? Or is it capital guaranteed? So let us spend a little bit of time just to get some results and see where we're at. Okay. Hoping for a bit more Slido participation this time around. Okay, so it's pretty close, but it's fair representation. Higher returns, lower risk are 25%, but capital guaranteed still seems to be the most, but it's pretty fairly evenly distributed. Okay, let's move on to HSBC Liquidity Solutions. Take it away, Catherine.
Hello, everyone. I'm Catherine. I'm from HSBC Asset Management. So today I'll be mostly talking about money market funds and also in particular two Hong Kong dollar and US dollar money market funds. So before I do that, I just wanted to give a quick introduction of HSBC Asset Management's liquidity business. So currently we are managing $145 billion in liquidity assets. It's actually a very core part of HSBC Asset Management. It makes up about 23% of our overall AUM. And also our history goes way back. So we have more than 25 years of experience in managing money market funds. And I'm based in Hong Kong, and we have a team in Asia, managing mostly Asian currencies, including Hong Kong dollar, renminbi, and in INR. But obviously, team is not just limited to the Asian team. We have a broader global team, which also manage major currency money market funds, including US dollar, sterling, and euro. Okay, so today, the session is mostly more an introduction to what money market funds are. And obviously, I'll take the opportunity to use our two funds and examples of money market funds. So please go to the next slide. Next slide, please. Sorry. Yeah, thank you. Okay, so just a quick introduction. So I think Hugh made a really good introduction of what money market funds are. But in the nutshell, I think it's fair to say money market funds are fairly similar to the other fixed income funds out there in the markets. But money market funds really focus on the very short end of the yield curve. So the key instruments that money market funds invest in are deposit, money market instruments, namely certificates of deposits, commercial papers, or short-dated, soon-to-mature bonds are also some common instrument types that money market funds invest in. But I think the key point is that money market funds typically focus on the shorter dated securities, as most money market funds have an objective to preserve capital and provide liquidity. And these are exactly the objectives of our global money fund, Hong Kong dollar funds, which we have the details of this fund on this page. So the Hong Kong dollar money market fund we have here is one of the longest standing funds in our HSBC liquidity fund range. It started in 1991, which makes it more than 30 years of track record. And the objective of the fund is really to preserve capital, provide liquidity, while at the same time provide an investment return that is comparable to normal Hong Kong dollar money market rates. And given this objective, you would not be surprised to know that the fund invests mostly in short-dated instruments like deposits, commercial papers, certificate of deposits, as mentioned, and also short-dated bonds. But I think regardless of the types of securities we invest in, we have a minimum credit rating requirement for the issuers or banks that we invest in. And that is minimum short-term credit rating of A1 or equivalent. So that is the minimum credit rating requirement for us. And also, given the objective is also to provide liquidity for our investor, so the fund has to have at least 20% of its assets in securities that are maturing overnight or government issues. The reason why we include government issues in our overnight bucket is really because government issues are the most liquid or actively traded instruments in the money market in our Hong Kong space, and therefore these are usually able to be traded on a T+0 basis, and therefore they are generally treated as an overnight security. And also, we also have specific guidelines as to how long the tenure that we can invest in for individual issues. So the longest we can invest for single security is 1 year. So we cannot invest in anything that is longer than 1 year. And also for overall average weighted maturity for our underlying holdings, overall cannot exceed 60 days. The current size of the fund is now about 5.75 billion Hong Kong dollars, and the yield has come down somewhat slightly from the 5.46% as of end of September to now more close to 4.68%, still very decent. And the reason for the drop was mostly because Hong Kong dollar market is usually quite a technical market, which is fairly sometimes it's fairly affected by technical factors like seasonal factors like quarter end and year end. And so therefore, usually towards the quarter end, year end, you would find the yields, generally speaking, would spike up a bit. But current yield is now at about 4.68, and the weighted average maturity of the fund is about 44 days. So moving on to the next slide, please. So here we have a more detailed breakdown of the portfolio. So as you can see from this chart here, I hope you would agree with me that this portfolio is a very highly liquid, very high quality, and geographically diversified portfolio. So if we look at the bottom middle charts there, you can see the overnight exposure is roughly about 23% of the portfolio. Again, this is the most liquid part of the portfolio. And in fact, if we look at securities maturing within a month, that's about 50% of the overall portfolio. And that is how liquid the portfolio is. And if we look at the portfolio broken down by security types on the top left-hand side, the charts there, it shows the largest security type invested by the portfolio is actually deposits. So 66% of the fund is actually deposits, and of which about 21% is actually overnight deposits. And then it's followed by certificate of deposits and commercial papers, which makes up about 26% of the portfolio, and followed by treasury bills, about 7.2%, and agency bonds, about 0.7%. So even though we have about 66% in deposits, that doesn't mean that we put everything into one bank. In fact, the 66% of the portfolio is made up of about 16 banks. So again, this portion is highly diversified into 16 banks. And also, if we look at the middle charts there, you can see because the fund's minimum credit rating requirement is short-term rating A1, so you can see that all the securities in the portfolio are actually rated A1 or above. In fact, about 42% are rated A1 above. So it's A1 plus, one notch above A1. So again, very, very liquid, very, very high quality portfolio. And also, if we look at the geographical breakdown, so you can see, despite it is a Hong Kong dollar fund, the exposure to Hong Kong is only about 15%. And if we look at mainland China, exposure is only about 6%. That means all the rest of the portfolio is invested in banks, in mostly in developed markets and also other Asian markets. So very, very geographically diversified. So while there are actually many other Hong Kong dollar money market funds out there, so not all of them actually are rated. And we are one of the few, if not the only fund that has a AAA credit rating, AAA fund rating obtained from Fitch. So we are one of the few, if not the only AAA rated fund in the market. And we are one of the biggest money market funds in the Hong Kong dollar money market space. And if we look at ourselves compared to our major peers, we are also one of the we place more emphasis on risk management compared to many other peers, reflected in some of the risk investment guidelines. For example, the minimum credit rating requirement. Not all the money market funds out there have the same credit rating requirements as we do. And also, there are also other money market funds out there that may invest in non-Hong Kong dollar exposure, like non-Hong Kong dollar denominated securities, and have the currency hedged back to Hong Kong dollar, whereas our fund invests purely in Hong Kong dollar instruments or deposits, and that gives our investors pure Hong Kong dollar exposure without the currency risk exposure. So moving on to the next slide, please. So this is the details for another money market funds we manage. It is the US dollar global money fund, US dollar fund. It is also quite a long-standing fund. It started also in 1991, and it has the same investment objective as the Hong Kong dollar fund, which is to preserve capital, provide liquidity, and also provide a money market return that is comparable to US dollar money market rates. And it also shares the same investment universe to the Hong Kong dollar money market funds. By that, I mean the same pool of issuers or banks, but obviously this fund will have to invest in US dollar denominated assets. But in a nutshell, the Hong Kong dollar fund and the US dollar fund, they basically follow the same process, have the same requirement on liquidity ladder, weighted average maturity, and minimum credit rating requirements. So broadly speaking, very similar investment guidelines. And the current size of the fund is now about US dollar 230 million, and the yield of the fund is now at roughly about 5.58, again slightly come down from the 5.79% there. So it has come down to about 5.58, and the WAM of the fund is now about 31 days. So next slide, please. So this slide also I'm going to show you the detailed breakdown of the portfolio. So as you can see from this page here, in terms of like the general quality, high diversification, and also liquidity, this is very similar to the Hong Kong dollar fund. But I think the key differentiation here is really the breakdown by security types. This fund has about 28% in deposits, and most of it is overnight deposits, and the CD and CP made up about 50% of the fund. So next slide, please. So why do people want to invest in money market funds? And I think the key benefits or the key reason highlighted by Hugh is the daily liquidity flexibility, but yet the competitive yields. So I think this can be illustrated very well in this chart and table. So the red line here represents our fund's yield over a period of time, and compare with the two gray lines, which represents the overnight HIBOR rate and the 1 month HIBOR rate. So as you can see, our fund yield is much more stable than the money market rates, as you would expect. But at the same time, if you look at the table at the bottom, over a period of time, our fund yield is much higher than overnight HIBOR rates, and also higher than the 1 week HIBOR rates. And even if we compare our fund deal with the 1-month HIBOR rates, we are actually not that far off. But bearing in mind that our fund actually gives investors daily liquidity. So this is exactly the reason why many investors prefer money market funds, given the more attractive yield, but the daily liquidity. Similarly, if we look at the next slide, please. This is a very similar chart for the US dollar. So as you can see, the red line again represents the fund yield. It moves very much in line with the market yield, as you can see. But again, over a period of time, it is not only outperforming the SOFR rate, which is an overnight rate, it also actually higher than the 1-month HIBOR rate. Again, highlights the benefit of money market funds. Next slide, please. So there are obviously other reasons for why people prefer money market funds. The first is, I think for most, it's obviously the safety element, relatively low risk. So as you can see from the charts here, the historical NAV per share for the two funds have been very, very stable, steadily going higher, reflecting the income from the investment. But the second and also very important reason is the diversification of credit risk and also the credit risk management. So think about yourself putting your money into a bank deposit. So you are really exposing yourself to one single bank credit risk. But if you invest in a money market fund, you are effectively investing in a range of different banks. So basically, you are not exposing to one single counterparty credit risk, but you are exposing to a number of banks. And in terms of diversification of credit risk, you are much, much more diversified compared to investing in perhaps one or two deposit banks. And also, best of all, it's all the securities, all the banks that are included in our portfolio, they have to be reviewed and fully analyzed by our credit analysts before they can make it into our investment universe, which means all of the holdings that we have in our portfolios have been fully analyzed and approved and also monitored on an ongoing basis in case of any credit deterioration or change in credit fundamental, and appropriate action can be taken. So again, comparing to time deposits or deposits, money market funds offer much more diversified credit risk. And also, not only credit risk can be properly managed. If you are investing in money market funds, you can also leverage the professional management expertise in not just credit risk management, but also interest rate risk management. So for example, so depending on our investment view, so which part of the investment or the yield curve that you should be focusing on, and depending on like the view on the outlook for the future interest rate path, our current market valuations properly reflecting this expectation, and if not, how are we going to be able to exploit this mispricing opportunity? So investing in money market funds, this will be taken care of by the fund manager. And very importantly, last but not the least, investing in money market funds you will also be able to have access to a fund fact sheet that gives you transparency on what sort of investment we are investing in, and also the key characteristics of the fund, and that also highlights the benefits of investing in money market funds. Next slide, please. But then obviously when it comes to choosing the right money market funds or choosing the partner where you put your money in, I think it is very important to understand that many investors who are looking to invest in funds, what they are really looking for is not just yield. They are really looking for capital preservation plus some yield enhancement. This is why at HSBC we believe risk management should be the primary objective, while yield enhancement should be important, but also should be somewhat secondary to the primary objective of capital preservation. And so therefore, when choosing the right partner, track record of meeting liquidity demand, as well as its risk management framework should be key for investors when considering choosing the right partner. And with our experience and resources in managing credit risk and also money market funds, we believe HSBC Asset Management have a better chance of achieving these objectives. So that is all I wanted to cover. So maybe now I'll back to Hugh.
Thank you very much, Catherine, for that detailed explanation. Christoph, I think you're up next.
Yes.
Okay, maybe to give you a breather, maybe we can have one last Slido question. And some of these are actually Slido questions that are coming in live as well. Poll number 3, do you think the Fed will start lowering rates in 2024? And while we wait, Christoph, if we can try to wrap it up by 7:50 to leave maybe 3 or so questions at the end, that would be great. But let's try to target that. Oh, so that's different in your time, in about 15 minutes.
Yeah, okay. So little introduction about Amundi. So in Amundi, we manage about 2 trillion we have about 2 trillion of asset under management. Amundi is Europe's largest asset manager in Europe. And in the top 10 in the world. Liquidity solution in Amundi include money market funds or mandate and ultra short-term bond funds or mandates. And the total of the assets managed in liquidity solution range represent basically 11% of the all asset managed by Amundi in the world. Obviously, we have a very long experience in managing money market funds because the first money market fund that we managed, it was in the middle of the 80s. So on my side, I am a senior portfolio manager since 2006 in Amundi and with a focus on USD solutions, which means money market funds and ultra short-term bonds mandates since 2010. So maybe we can move on. Okay. So very balanced.
Okay, yeah, hiking comes to an end, no higher for longer. Okay, it's pretty balanced. Okay.
Okay, so maybe I will try to give you some an answer about where we go in terms of interest rates. So maybe we can move on the slide about economic data. Next one, I think. Yes, the second one. The following one, yes, this one. So you have here on the left the inflation rate evolution, the headline inflation, the dark blue line, and the core inflation, the light blue lines. On the right, the blue lines and the left hand side, unemployment rate, and red line, right hand side, the whole earnings. So clearly, inflation is clearly oriented on the downside for several months, but it rose recently because of energy prices. And regarding the labor market is more balanced now with upper participation rate and less vacant jobs. However, you can see that unemployment rate is close to its historic lowest, and above all, the fact that we have a very strong earnings, and the fact that at 5% wages rate is still far from pre-pandemic levels. So US economy basically remains resilient. Last week we had a very good GDP. The third quarter at 4.9% versus 4.5% expected. So clearly in this context, the Fed has no reason to drop its key rate and should very likely maintain a restrictive money market policy for a while. So we could expect short-term rates remain attractive next year, probably close to their current levels. Next slide. After 150 BPs hikes of rate increase, since March 2022, short-term rates have become attractive. On the chart on the left, the US Treasury curve, even if the US curve inversion is less strong than it was a few months ago, US Treasury yield curve remains inverted with a peak around the 6 months at 550%, as you can see on this slide. Regarding the slide on the graph on the graph on the right, the spread between the 10 years yield minus the spread between the 3 months T-bills and the 10 years yield 10 years yield, you can see that from an historical point of view, we have back to a 40-year high with currently a spread around 70 BPs after reaching a peak at 185 BPs few months ago. On the next slide, the higher for longer mantra. So in this slide, you have Fed members' key rate expectation for the coming years and the OES forward curve. So in September, Fed members surprised investors by revising up their forecast on the US economy and by raising significantly their GDP target, for example, 2.1% for 2023 versus 1% at their last quarterly review in June, and 1.5% for the GDP in 2024 versus 1.1% in June. So logically, they also updated their key rate forecast, so the dots, by 50 BPs in 2024 and 2025. However, as you can see with the blue line, market continue to expect more interest rate cuts than the one expected by the Fed's officials. Next slide. Yes, this one. On the left, the 12-month and 3-month yield evolution of the main bank issuers since the start of the years and the Fed funds rate evolutions. So after the sharp drop following the US regional banks turmoil last March, you can see that yields have risen sharply following key rates increase and the fact that we had also a more hawkish turn of the Fed, taking into account that the US economy appears much more resilient than expected. But you can see also that yields tend to stabilize in July, and they are now close to their highest. On the right, the recent yield curve, still from large banks CP issuances levels and their spread against OES Fed funds swap curve. So you can see that yield and spread are attractive. You can see that over 6-month yields are above 5.75%, and even on an historic point of view, spread are also attractive. For example, about 50 BPs for a 1-year commercial paper issuance level. So maybe we can drop on, not this slide, please go ahead. Again. The following slide, please. After this one, yes, this one. So in this chart, you have the weighted average life and the modified duration evolution of one of the funds I manage, the short-term low volatility NAV funds, weighted triple-E by S&P and Fitch. And you can see that it's really important. It was really important in 2022 when Fed decided to start its hiking cycle to manage very cautiously the duration of the portfolio. So to mitigate the impact of successive interest rate hikes, it was, as I said, really crucial to maintain the modified duration largely below the fund's guideline, which is actually at 60 days, by selecting, for example, SOFR index securities, by hedging with interest rate swap fixed income securities with a longer maturity. This strategy allowed to a return consistent with the fund's benchmark return, in this case, the Fed funds effective rate. But recently, considering that we are very close to the end of the hiking cycle, and taking into account the attractiveness of yield, as you have seen before, the duration have been increased and should gradually come back close to its guidelines. This is the case for this fund, but for another fund that I manage, Amundi Fund Cash Dollars, the fund you mentioned earlier. Maybe we can move to the outlook. Go ahead, please. Yes, this one. So 2024 could be more challenging for US money market fund. In 2023, except the US regional bank episode, and despite the debt selling issues, the short-term market functioned well. We didn't have any liquidity issues even with the large US T-bill issuances. The large volume of T-bill issuances have been finally well absorbed by US money market fund. But there are at least two big potential issues in 2024, which is actually positive for short-term rate, could be positive for short-term rate. The chart on the right, you have an impressive asset under management evolution of the US government money market funds, who benefited in 2023 from an acceleration of banking deposit outflows following some US regional bankruptcies, and more globally from the gap in between yield offered by banks deposit and money market funds return. Taking into account that US Treasury wants to increase the percentage of T-bill in its funding, any drop of money market funds asset under management could cause an issue for the Treasury and leading higher return and higher spread, pushing unsecured spread also on the upside. The chart on the left, the bank reserves with the Fed. We know since last July that the quantitative tightening, the Fed's balance sheet reduction, will continue in 2024. This could also cause another issue for the short-term markets. Fed's balance sheet reduction drain excess liquidity because the excess reserves with the Fed become lower. So, however, bank liquidity regulation increase bank demands for reserve as reserve deposits as the Fed satisfies LCR constraints. So, if excess reserve becomes scarce, bank will need to rely more and more on short-term front-end substitutes with little credit risk, like T-bill, reverse repo, federal home loans banks, which are growing risk to see short-term secure and unsecured being oriented upwards. So, in conclusion, we can expect that Fed will maintain short-term rate at their current level, at least until mid-2024. That's the first point. So, short-term rate will stay at a interesting level, historically speaking, but taking into account the two factors that I mentioned, we could expect also pressures on the short-term rates probably at the end of the next year, at the end of 2024, will also imply higher spread on the short-term market, and that will benefit at the end of the day to US money market fund to maintain a significant yield, including when the Fed will start to reduce, to cut its QE. So yeah, conclusion. So I think it's a very good momentum to invest in US money market funds. So US money market yields are very attractive and will stay attractive in the coming quarters, let's say. We are close to the end of the hiking cycle, and Fed will maintain a hawkish statement, and so short-term rates will stay higher for longer. By investing in European money market funds, you invest on highly regulated vehicles, and but as a portfolio manager, we need to have an active funds management in order to optimize liquidity and return, and this is possible thanks to a solid internal risk framework. So maybe it's time for the Q&A session. Yes.
Yeah, thank you, Christophe. Actually, both Catherine and Christophe managed to answer a lot of the questions that were coming in live, which was actually not coordinated, but that's great. But I still think there are a few questions that we can answer. One, I'll go with Catherine first, and this one is because HSBC has both US dollar and Hong Kong dollar money market funds on our platform. The question is, if I have Hong Kong dollar cash, should I convert it to US dollar to invest in US dollar money market funds or invest in Hong Kong dollar money market funds? That's the first question. So Catherine, you want to take that?
Thank you. So that is a very interesting question. Sometimes I do wonder myself for my own investment. But then I think one need to understand, like, if you are a Hong Kong dollar based investor, if you convert your Hong Kong dollar to US dollar, even though the currency exchange rates are somewhat packed, but you are still somewhat exposed to the currency exchange rate risk. That is one. And also the fact that you need to convert Hong Kong dollar to US dollar, and therefore that might also involve some cost when you convert. That's one thing. And also, if we look at the Hong Kong dollar and US dollar money market rates, so because the two currencies are currently packed, and so in terms of the direction and movement, actually you would see both market rates are actually moving somewhat in tandem, maybe with a delay. But if we look at the spread between Hong Kong dollar and US dollar now, it's actually not that significant compared to perhaps the cost of converting the currency and also the potential exchange risk that you'll be entitled to. So I think after all, I think it really depends on the investors, whether or not the investors is actually Hong Kong dollar based, and therefore having US dollar exposure means an additional risk to the investor. After all, investors who are looking to invest money market funds, they are indeed looking for capital preservation. So that is something that I think would need to be taken into consideration: the exchange rate risk and also the additional benefits of converting from one currency to another.
Thank you, Catherine. So next question goes to Christophe, because he did mention a view on interest rates. And the question was really, do you believe that interest rates will stabilize or begin decreasing? And then what cash management strategy would you recommend to ensure optimal return? So it's basically also asking, you know, the person who asked the question thinks that investors should employ a new strategy with interest rates expecting to peak or reaching peak. So I guess the question that I would frame around that is, I know you said it's higher for short-term rates are higher for longer for at least mid next year, but you know, in order to optimize that, what would be your best strategy? Would it to be keeping it in US dollar money market funds for a really long time, or would it be to try and, you know, have the liquidity so you can be ready to invest in bonds or other things? I mean, do you have any thoughts on that?
So on my side, the strategy that I decided about since, let's say, July, is to increase the duration of the portfolio, both credit duration and modified duration, by investing in fixed income, commercial paper or securities, basically, on maturities above 6 months, let's say from 6 months to 1 year. The fund and manage, the modified duration has to be below 90 days. It's currently around 70 days. The credit duration must to be below 1 year, is currently around 4 months. So I have leeway, let's say, to increase again duration, both in terms of interest rate duration and credit duration, in order to maintain and obviously to increase the yield to maturity of the funds, probably close to 570% in the coming weeks. So that, and yes, so basically we can expect at least that interest rate will stay at their current level, or maybe slightly above their current level in the coming quarters. But obviously, there are several reasons to think that probably the US economy could face a recession episode probably in mid 2024, and in this case, obviously, Fed will start to decrease its key rates. So that's the reason why I think the good strategy is to increase the duration portfolio, the funds durations portfolio, sorry, by investing on fixed income securities.
Got it. Thank you very much. In the interest of time, I'll take a stab at the last question very quickly. So the question is, how should investors select the right money market funds or cash funds? Are there any specific criteria factors investors should consider? We believe that, I think Catherine covered a bit of this, we believe that transparency is very, very important. The money market fund showing what they're investing in. Risk management is also very, very important. We also look at the historical volatility and drawdowns of money market funds, also the track record, the size, and I believe our partners here both offer very, very high quality money market funds. And with that, I wanted to conclude our session today. Thank you very much, Christophe, for dialing in from Paris, delaying your lunch, Catherine for dialing in so late from Hong Kong, and our clients who are dialing in from Hong Kong and Singapore. Thank you very much.
Thanks to all.
Thank you.